Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of February 12th, 2024. This is our 50th posting. We do this about 10 times a year now. And what our goal with this is to give our clients and other market participants a general update on the municipal market and how things have trended from month to month, approximately. But my name is Adam Bauer. I serve as CEO and president of Fieldman Rolapp Associates. Our firm is a municipal advisor to government. On our first slide here, there's a lot on this chart, but we're going to break it down. And when you break it down by its components, it's actually quite simple. The first thing let's focus on are those green bar charts. And the key for those green bars are to the far right, vertical axis. That is a number of basis point change, or 0.25, 0.5, 0.75 increments that the Federal Reserve has increased the overnight rate. And you can see that really began in March of 22. And you saw a 25 basis point increase there, followed by May, where you saw 50 basis points. And then you saw the 75 times 4. And then eventually we trended back a little bit lower. So the green bar charts represent the Fed changes. The yellow line is the aggregate of all those changes. And so as you see a green bar increase, you should see a corresponding yellow line increase. And then what we've layered in on top of that, and I'm sorry, for the yellow line, the access to that is the far left. And then the blue line is a 10-year treasury, and a lot of financial market interest rates are based off that 10-year treasury. And so it's a good indicator of how interest rates are moving in a broad sense. And one thing I have found very interesting about this chart is in the early days, that 10-year treasury tended to drift upward as the yellow line did. And so as the Fed made increases, the 10-year treasury corresponded to that. And you can see that essentially through November of 22. And then you can see that started to change. I want to refresh your memory on November of 22. In November of 22, while it was a long speech, I think the takeaway from Jerome Powell's speech was, we're going to keep rates high for longer, but we're not going to increase to the same magnitude that we had. So keep in mind, you're coming off 4 75 basis point increases. And so when investors heard that there might still be some increases, or it might be higher for longer, the idea that we're not going to see 75 basis points, I think, was really, you could see there with the 10-year treasury rates stop going up. And so you can see some traditional dips and increases like you would in any financial graph, which you see later in that chart. And so then you generally see rates staying flat, but also trending a little upward until November of 23. And once again, there was a speech made. And I think at that speech was, we may not need to increase anymore. So November of 22, we're going to moderate our increases. November of 23, we may not need to increase anymore. But you saw rates trend lower in both those situations. And then generally at the end of January, we did see rates trend upward. We saw a lot of volume in the market. And also, I think because some of the economic data was so positive, some of the rate decreases that some investors were expecting either got pushed out or no longer expected in the same fashion. So all those things led to some inching upward of interest rates. And so I think you can see that with that 10-year treasury there. So when you break that down, it's not as complicated as it looks at first, but we think those 3 things are good to look at together. On our next chart, we're showing you here is just how interest rates have changed between 1/3/2022, so January 3rd, 2022, and as of to February 12th, 2024. And you're gonna, if you've been watching these MMUs, you know I reference that January 3rd, 2022 quite frequently. And the reason for that is up until that date, when people in the financial news talked about inflation, they always said transitory in front of it. something happened on January 3rd, 2022, where some started dropping that transitory. And I think that folks thought that the Fed would start increasing. They didn't until March, but folks started to anticipate that. And so you started to see that trend upward. So the blue line is where rates were on 1/3/2022, traditional yield curve. As you go out longer, higher interest rates. But now look at February 12th, 2024, not a traditional yield curve, and also much higher than where rates were in January 3rd, 2022. So just try to give you some perspective on how things have changed since we really started seeing rates increase. This chart I find very interesting, and I wish we could put smaller font and show you a longer history. But the middle column there is the 30-year MMD, municipal market data yield curve, the AAA, and it shows you where that was the day before that month. So it's the last day of the prior month. So for that first example, Feb 1 of 2023, we're looking at January 31st of 23. That's where it ended. And you can see that in March, rates went up for that 30-year MMD. And you can, I won't go through each month. But let's get to the bottom there. When I talked about rates declining in that November timeframe, that's really captured in that December data, right? So that it didn't happen November 1st, right? So when you got to that December data, you really captured those declines because keep in mind that December data point is as of November 30th. So during that month of November, you saw an 80 basis point decline. And then that continued in December, where the first January 2nd date that we all came back to business, you saw that December had a 34 basis point decline. So pretty substantial decline between those 2 months. Now, things stayed pretty steady through most of January. And you can see that by just 1 basis point decline in that 30-year MMD. I'm going to show you a chart in a minute, though. This changes in with the February data. I don't have the percentage to change, but I do show you what the 30-year MMD is on the next slide here. And so this really just helps give you some perspective on how that 30-year MMD has changed on a month-over-month data. So here's our chart of, instead of just taking that 30-year MMD, we take years 1 through 30. Each one has its own interest rate. And you can see there that well, let me take a step back. The blue bars represent the range of interest rates for each one of those maturities going back to 2005. The green line represents the MMD for each one of those maturities on February 12th, 2024. And hopefully what you're noticing is we're kind of in the middle, a little bit on the lower end of the middle range on the longer maturities. And then on the early maturities, we're a bit elevated. But check out that 30-year MMD. Look where that's at 3.59. That was all the change from when we stopped. The month ended in January and February 12th of 2024. So you certainly have seen an increase in the beginning of February. It'll be interesting to see what happens the second half and if we get some of that back or if that trend continues. On this chart, giving you a whole lot of data, but if depending on who's reviewing this, it can be very interesting. A few data points that I'll point out is the far top right chart. You can see the competitive, negotiated, and direct placements. Those private placements, I expect will not be as robust as they have previously, in large part because we hear about the regional banks not performing as well as they had previously and may not have as much to lend, but that'll be an interesting trend to watch. The other thing is that bottom left chart there, where you're looking at taxable versus tax exempt. And you can see 20 and 21, that's where we did the industry did a lot of taxable fundings when rates were just very low. And you can see we certainly don't have nearly as much of that now. And then that bottom right chart, you'll see there refunding versus new money. And you can see with rates being somewhat elevated, we have much less refundings to do. The other thing is rates were so low in 20 and 21, those taxable deals pulled forward deals that might otherwise have been done in the 23-24 timeframe. And so you see like I said, pulled those deals forward. So probably contributed to some degree to not having as many refundings in 2023-24. This is our inflow and outflow chart, and you can, and the reason why it's so important is the municipal funds buy a substantial portion of the municipal bonds. Now, there is some data I received from an underwriter today that suggests that there's been some flows that don't quite show up on this chart that are positive, so they're being the green bars. But this is when money's flowing in, there's more funds available to buy bonds, and when money's flowing out, there's generally less. So certainly has not been that positive through much of 22 and 23. Here's our volume and our issuances here, and you can get some perspective on how we've been trending over the last few years. And you can also see how we've done on a week-over-week basis. This is difficult to look at so early in the year, but I think as the year progresses, this will be a much more useful chart to give us an indication of how we're trending from prior years. Here's some of the economic data points to monitor going forward. And then finally, here's our registered municipal advisors at Fieldman, Rolapp Associates. We all thank you for your time. I encourage you to reach out to any one of these individuals if there's anything that I spoke to today that you would like more information on. But thank you for your time and look forward to talking with you in a few weeks.